What is the difference between the economy and the stock market? This week, we're going to be talking about how the U.S. stock market is projected to perform and how the U.S. economy is projected to perform. What are the similarities? What are the differences? It's important to know as you make better wealth decisions. This is Make Better Wealth Decisions, a podcast about financial blind spots, decision-making, and how the reality of higher rates, global tensions, and tariff instability impact your investments. I'm your host, John DeGuy, a portfolio manager with Design Securities in Toronto. This week, we're speaking with Dave Wahl. He is a director at ClearBridge Investments, and he is a longtime friend of the Make Better Wealth Decisions podcast. This is the third time that Dave has appeared, and he is the only person who has appeared 3 times, and that's because what he has to say is really important. We're talking today about the anatomy of a recession, which is research that is done on an ongoing basis by the people at ClearBridge. They put out the information quarterly, and they track, using a stoplight analogy, what's going on with the various economic indicators and what we should be expecting for the economy, which is not the same as the stock market, going forward. And it's got a very U.S. focused bit of research, but I think it's also the sort of thing that's really important. So let's get into it. Dave, how are you today?
I'm doing great, John. I'm honored to be the only 3-time attendee or presenter, but I'm also, when you're a longtime friend of your group or someone, that means we've just been around way too long, John, maybe. I don't know, but we're getting older, but wiser. Let's put it that way.
Well, I'm very sure about older. I'm not so sure about wiser.
I know you try hard to be wiser.
We just had a presentation from your people on Friday where we were told what to expect for the forthcoming quarter. And then usually you can extrapolate that might be a reasonable expectation for the coming quarters and maybe even for the coming year.
Correct.
So what are the main indicators right now from ClearBridge with regard to what we might be expecting from a recession, and what are those indicators showing?
Yeah, it's a good start. I think it's the right spot to start. And it's really where we base all our information from, John, and to the people listening today or going to listen to. We look at the 12 variables that we think most closely indicate to us what's going to happen in the economic environment going forward, which is basically, are we in a slowdown? Are we in an expansionary era? And currently our dashboard, although we've had a couple of changes and we have 12 variables, like you rightly said, green meaning expansionary, yellow caution, red meaning slowdown, recessionary. We don't necessarily think that that's going to happen, but right now we're solidly in an expansionary zone. We're solidly signaling green. We would probably, if we had to put a percentage around it, 75-25, that we are in a solid expansionary zone. And when you think that 15 is our minimum, saying that would be 85-15 in an expansion, that's pretty solid in the expansionary form going forward.
Great. Okay, so that's a good way of setting the backdrop. And I'm going to have a few questions because I, as you know, from time to time, think that the findings are a bit counterintuitive, but we've done this twice before. And the past 2 times, what you have said has been far more right than wrong. So far be it from me to suggest that there's anything incorrect. But there are certain things that it struck me when I was listening to the presentation that were conspicuously not talked about. And I guess I'll get into that in a few moments. So one of the things that we heard was that there's a consensus that GDP would grow by 2.1% in the U.S. In the coming quarters. And that strikes me as being really positive. And the main reasons being given, and I'm wondering if you can perhaps offer your thoughts on this, was what are called the twin tailwinds of both fiscal and monetary support. Maybe you could take a moment just to talk about both those tailwinds and what it means.
Yeah, we're in a really unique environment in the U.S. right now, whereby we have an expansionary economic environment, and we think that's going to continue. And the number that you quoted is the number that we agree to. But it's a really unique time in the U.S. where you have monetary policy easing, where you have a Fed rate that's probably going to decrease, and we believe it will at least a couple of times in 2026. With at the same time an expansionary environment where we're getting stimulus from tax, one big beautiful bill, et cetera, that is putting a fiscal impulse into the environment. Both of those things combined with a very robust earnings per share outlook or earnings per share growth outlook for corporations in the U.S. are combining to make this a very unique opportunity to have the economic environment continue, but also to see the markets participate on the upside because of that.
On the monetary side, there's a pretty strong consensus. And again, you don't want to get into too much with regard to forecasts, but the strong consensus is that Jay Powell will simply stay the course and keep rates as they are for the remainder of his term. And it is only when a new chair for the Federal Reserve is installed when rates will start coming down. The first meeting that will be held with the new chair will be rates set on June 24th. And I think one of the things that you've been saying, that Franklin ClearBridge has been saying, and I think that a lot of commentators intuitively expect, is that the first of those rate cuts that you've talked about will likely come on June 24th. Is that probably fair?
Yeah, that's fair comment. And that's what we're seeing in the marketplace. And that's really what's being priced into the market as well.
Okay, so stoplight analogy, 12 different indicators. There were only two that were negative. I just wanted to talk about the two. They're mostly green, but the two that were negative were job sentiment and ISM new orders. I don't know that there's anything particularly concerning about those two negative things. I know I'm not particularly fussed about them, but I'm wondering if you have any comments or we can just move on.
I think we can move on. I mean, ISM new orders was a little bit around. We had a fairly big run up in inventory, et cetera, early in the year. We've had a little bit of a downgrade, just a little weakening in future orders, but we don't see that. It's not the largest contributor to our dashboard. We don't see that as a big problem. And overall, still flashing green, as you said. Job sentiment is a funny one. Job sentiment is even though the people believe that it's harder to find a job right now, and the employment sector in the U.S. is a little bit weaker, but it's not to the point where we're concerned with. There's a little bit of weakness in the job market. Job creations, we think, are going to average between 50 and 70,000 per month going forward. It used to be, John, 100,000 was kind of the indicator. Above that, positive; below that, negative. But with a lot of the things going on in the U.S. with the government being able, the Supreme Court has validated the fact that the Trump administration can let government workers go. That's going to be a drag on job creation going forward, usually a net positive when it comes to jobs. Mass deportation in the U.S., little and very limited immigration, and productivity increases with AI, not maybe hitting the dashboard now, but in the future will probably tamp down the number of jobs that are created. But overall, we think that'll be maybe a little weaker in the first part of the year, but going forward, that will strengthen. So that will allow the Fed to maintain and decrease rates.
One of the things that I learned about the fiscal changes that are coming down the pike in the U.S. is the multiplier effects in terms of how much people spend of the tax money that they're saving. And I really hadn't thought about how that breaks down. But what I learned was, you can maybe speak to this, is that people who are making under $75,000 a year spend 80% of the money that they save, but the people that are making over $150,000 a year spend only 50% of what they save. So there's a bigger multiplier effect for the people that are on the low income end of the curve in terms of actually injecting money into the economy and keeping things moving along. I don't know if you have anything that you want to say about that, but I thought it was an interesting observation that I really never thought of before.
Yeah, and that's a great catch on the commentary that Schultz put forward, because a lot of people don't realize that. And that came from the COVID numbers of the COVID benefits that people were receiving. Those on the lower income scale, they spent far greater of their amounts. And that's good because wage growth is slowing, and actually year over year wage gains are decreasing in the US right now. And that's really hard on the lower, say 40% of consumers, maybe even up to the 60% of consumers. So by getting these tax benefits and fiscal impulse for the new year from the one big beautiful bill that Trump implemented, I think it will really help those lower wage earners and will show an impact on their spending going forward. Right now, about the top 20, 30% of spenders or consumers in the US are spending 60% of all monies that are in the consumer markets. And we know that the retail and the consumer are a very big driver of GDP growth going forward. So when you extrapolate that a little bit, John, the net impulse or the fiscal impulse of the one big beautiful bill for 2026 is going to be about 1% of GDP, which is an astronomical amount. And a lot of that, or a good portion of that, is going to be apportioned to the lower income groups. And that's helpful for them for sure, considering what's going on in the wage sector.
So one of the other things that I learned in listening to the presentation and conveying this to people listening today, and we'll be talking about this more next week with my guest who is going to be talking about the importance of electricity as an investment, is that the hyperscalers in the US, there are 5 companies that are sort of seen as the hyperscalers, who are just spending money like mad, are planning on spending 3.8 times more on CapEx, on capital expenditure in 2026 than they have in the recent past. So when you start talking about the need to hyperscale with regard to electricity use and the ability to actually have the infrastructure in place to let AI do what AI needs to do, a lot of that money is being spent on hyperscaling the electricity grid. And I don't think a lot of people have really thought about that. And I don't know if you've got a comment about that either, but I wanted to put it out there as another consideration that hit my radar that I went, oh, I really hadn't thought of that before.
Well, that's it. That's about an hour of discussion, John. Maybe for another time for your group and next week. And I think it's a very important topic for sure. That not a lot of people are thinking about the boringness of utilities, which are really coming to the forefront and becoming more growth companies for sure. The CapEx that's expended, and a lot of times we are expected, and a lot of times we undershoot the amount of CapEx that's going on. 3.8 times is going from 2023 levels to 2027 levels. And that's a huge, a 4-time increase in the amount of CapEx that's being spent on hyperscalers. And you're right. When you're spending that much money, a lot of that for data centers, a lot of that is requiring a ton of electricity. And because of that, you see a lot of electrical bills and consumer bills in the US increasing by multiples, not just by a few percents, but multiples going forward. And I think it's something that's really going to have to be addressed. And it's not slowing. If you look at the last quarter of 2025, hyperscalers increased their CapEx by $50 billion in 2.5 months. So that's going to continue. And that'll be a great topic for your next week. And it is a really good and interesting investment opportunity where you get a utility, maybe being a growth company going forward.
And that's exactly what we're going to be talking about. So there it is. So up until now, one of the things that I always point out is that the economy and the stock market are different things. And we've been talking up until now about the economy and about whether or not we're in for a recession. There's a strong consensus we're not. To the extent that we can, and again, it's a bit of a mug's game because they're different things, but I would like to see if we can maybe extrapolate with regard to what we might reasonably expect, all else being equal, with regard to capital markets for the next little while. So let's talk about the stock market. Cutting exposure to the US might be good for non-US markets. A lot of people are saying that this might be a good time to, given that the US has done so well and other markets have lagged, this might be a good time to maybe put a little more money, if either strategically or tactically, because let's face it, strategically, if you have an asset allocation where say 50% of your stock exposure is to the US and you had it at 50-50 2 or 3 years ago and you didn't do anything, you didn't put money in or you didn't take any money out, you might very well be at 55-45 or 60-40 right now because the US has done relatively well. Maybe not so much in 2025, but in the years immediately prior, it has. Any thoughts as to whether or not it would be a worthwhile endeavor to consider maybe either strategically or tactically moving some money to other parts of the world as a risk management endeavor, or maybe just as a general portfolio discipline perspective?
Yeah, and we believe that there is going to be a broadening out of the market. 2 phases. One, from a broadening up from the Mag 7 and the Magnificent 7. I mean, in the past, they've had earnings, and they were really the only earnings growth game in town when it came to the S&P 500 for a couple of years, John. And you saw that they got rewarded by valuations for the earnings per growth. We're starting to see that that's becoming a little bit more conversion, and that the broader market, the rest of the S&P 500, the 493 and the Mag 7, there's not as great a disparity between their earnings per share growth or earnings per share estimates. So we're starting to see that just from that valuation perspective, there's an opportunity to broaden out the market. And really, when it comes to concentration and you see 40% concentration of the top 10 names in the S&P 500 right now, that does say not only in the US that there's lots of opportunity to broaden out, like I talked about with earnings per share growth, but also when it comes to broadening out from a international perspective. So two of those things, when you get a market cap or a concentration of the top 10 over 25%, and I just said we're at 40, the next 5-year performance of the equal weight, meaning broadened 500 names, all taken as equal weights in the index, that outperformance is fairly substantial over the 5-year period going forward. So historically, anytime you're over 25% concentration, the broader or the equal weight S&P 500 outperforms the S&P 500 cap weight, which we all talk about, by 4% on an annualized basis. So pretty substantial if you want to look at it from that perspective. The other thing,
Okay, I was just going to say from a risk management perspective, that to me means moving away from cap weighted or moving away from large cap toward mid cap and small cap, just because those segments of the larger market are better positioned going forward.
I agreed. And when you look at that from a non-US opportunity, which you also spoke to, the valuations of international versus US, they always trade at a discount, John. It's always about a 3 times multiple discount. But now, right at this moment, we're at about 7, just over 7. So there's a very large opportunity if history is going to revert to the mean, which you and I are old enough to both know it usually does. Sometimes it takes a long time, but we're in a marketplace where you can see, and we did have for a bit of the year prior in 2025, we had some good outperformance in international, and we think that's going to continue going forward. A couple of things to that. When you get concentration from an international perspective in the US market of over 25%, the next 5-year performance of the S&P 500 versus an international, say the MSCI ACWI, which includes everything except the US, that outperforms over the next 5 years on an annualized perspective by 3% each year. So you see opportunities not only to broaden out in the US market, but great opportunities to broaden out in the international markets. And if you overlay that with the fact that Donald Trump and the administration, there's a few things that he's a proponent of. One is low energy, and 2, he really likes the markets, but he's a weak dollar president. He is pushing for a weaker US dollar. And if you think we're in a secular downtrend when it comes to US dollar, and maybe not this year, maybe we're in kind of a strengthening, kind of flat for the first half of this year. But after that, we see that secular downturn continuing in the valuation of the dollar. When you see that happening, it's very good for outside of US markets all the way. The riskier you go, especially, the greatest outperformance usually comes from emerging markets. So lots of opportunities with where it is in the US right now in the S&P 500.
And speaking of the S&P 500, one of the things that I learned was that of the Mag 7 stocks, there were only 2, NVIDIA and Alphabet, that actually outperformed the S&P 500 in 2025. So already, even among the Mag 7, 5 of the 7 outperformed the broader index and failed to outperform the broader index. And so, as I say, the things that we've seen in terms of these 7 companies driving the bus, that may have been true for the past number of years. That was less true in 2025 than a lot of people might have intuitively thought. And it's worth at least pointing it out that, as a matter of fact, it was only those 2 companies that outperformed the broader index.
Absolutely.
And I think
and that goes to again, active management on the money side versus passive management. We've had a couple of years. If you were in just those hyperscalers or the largest mega caps in the US, John, you did okay. History shows us that that's not what happens year after year after year. And especially if you're still banking on that outperformance of those large names, 2025 showed that only 2 of them, like you said, outperformed the S&P 500. And those generally going forward, they won't be the same. An old colleague of mine once said, John, that the Mag 7's a funny name for those hyperscalers, because if you ever watch the movie, The Magnificent Seven, what happens? They don't all make it. And maybe it's a dirty trick being played on us, or maybe it's foreshadowing. I don't know. I'll just say that this is a very good time to have proper advice and really use active management and maybe take a little bit off the table if you're using, passive management or passive investments.
One of the things that I write a lot and speak a lot about optimism bias. And one of the things that struck me that, again, it's worth noting as a matter of fact, because I'm always worried about this, is that as a matter of fact, you would do very well if you invested your money when markets hit all-time highs. And a lot of people are actually afraid of putting money into the market when you're at all-time highs because they think, well, it's at an all-time high. It can only go down from here. But in fact, markets climb a wall of worry, and the only way that you can hit new highs is by continuing to hit new highs. You can't just wait forever. There's a view here, and I'm wondering if I could maybe end the broad macro discussion with a discussion about the view that Franklin ClearBridge has that we're in a broad secular bull market that began in 2009. Explain to us what that means and how long you see that lasting.
Yeah, and this is an important slide for us. And any time that I'm speaking about this, not just to your group, but across Canada, as I do, we always end with this slide because it's important for people to realize these are long-term trends. And will there be pullbacks? Certainly there'll be pullbacks. And if you look at an example of the Mag 7, some of them have, NVIDIA's had 50% pullbacks since their inception. So there are times when the market doesn't go straight up. There are little pullbacks, and some of those are healthy for the market. We certainly believe, John, that since 1930 is how long we went back, there are periods of 10 to 20 years we're in a secular bull market, followed by a secular bear market. And those trends continue. And if you look through history, we continue to see that. We started this, when you're correct, about mid to the end of 2009. So say 2010 forward, we think we're in now, 2026, the 16th year of a 20-year bull market. And if that's the case, we see lots of opportunity for upside in the S&P. And again, you had correctly mentioned at the beginning, it's usually around the S&P 500 that I speak, but this broadens out to most of the global markets. We think we are in year 16 of 20. So we have a 4-year run. And where do we think that's going to come from? We talk a lot about productivity. I don't think that we touched on it quite so much here, but productivity, which for us lay people, that's just how many assets you can deploy to make how many widgets. And if you can increase the number of widgets with your assets, that's an increase in productivity. We think AI is now to the point where it's going to be monetized a little bit out. It's going to be broadened out to the market and different sectors of the market. And there's going to be a real opportunity for businesses to take advantage of AI and increase productivity. And that will have a large impact on valuations going forward of companies and the markets. So we think really, John, that's where the next 4 years productivity is going to drive higher valuations.
Okay, so I just wanted to take one quick moment to tie something down that you said a moment ago. Donald Trump being a weak dollar president, one of the things that was said was that if that's in fact the case, it might be a good time to move out of more financial assets and more into hard assets as a hedge against that sort of an outcome, or in order to capitalize on it. So I want to push back on something now. So we're great pals, we get along, and when I listen to these presentations, I just always think, well, great. And as I say, the folks at Franklin ClearBridge have been more right than wrong, for sure, in the past 2 times I've had you on. This time, there was a poll taken by the thousands of people that were listening in on the call, the presentation that Franklin ClearBridge gave to advisors across North America, in terms of what do you expect in terms of the market, the S&P, to do over the course of calendar 2026. And 55% expected the market to go up from 0 to 10%, and another 42% expected the market to go up by over 10%. That's 97% of the people on the call expected the S&P 500 to go up in calendar 2026. I confess that I find that to be, full disclosure, I'm one of the people who voted for the 3% who thought the market might actually drop. So full disclosure, that's who I am. So I'm putting my cards on the table. I'm surprised that it's all fine and well to be optimistic, but here's my pushback. On the one hand, you say that these secular bull markets last 10 to 20 years, and then you say, we're in year 16 of 20. But if it's a 10 to 20 year period, who's to say it might not end after 15 or 16 years? Mm-hmm. And I'm not so sure that we should be as comfortable as we have been. But here's where I really, really wanted to make the point, and that is that when I speak to people in finance, they talk about finance in a vacuum, which is to say they don't talk about what's going on geopolitically. So we now have a world which is more dangerous, where supply chains are being disrupted, where wars are being started and prolonged, where we don't necessarily know who our allies are, and our allies are seen as being unreliable. And we have to find new sources of supply and do other things to be more resilient. And all those things cost money. And I don't see any of that abating at all in 2026. In fact, I see the things that have been in place for a number of years accelerating in terms of deglobalization. And I think deglobalization is a real threat to stock markets. But whenever I hear people in finance talk, they don't say a word about what's going on, as if, well, we don't talk about that. So I'd like to talk about that. What is your take on deglobalization in terms of what it means for markets going forward?
So deglobalization is a large topic, but here's what we do. When we talk about an investable time frame, John, we usually talk 3 to 5 years, and I'll go back to the geopolitical risks as well. And they do cause a lot of panic attacks, and I'll talk about them from a historical context to continue the conversation with you. And you are a great advisor because, and I know for many, many years of knowing you, it's never easy. There's never just a smooth path to say, this is what it's going to be, and you agree. So I like that. And it does create a lot of discussion. We think that currently where we are, and geopolitical aside, that we're in an excellent position to continue that trend. And I talked about that a little bit earlier on. We think from a U.S. economic outlook, fiscal and monetary policy are going to provide foundation for growth going forward in 2026. CapEx boom we talked about, that's going to continue. And if you look historically, the amount of CapEx being spent on AI versus the railroad, when they had the expansion of the railroad, 3% of CapEx was GDP, was to the railroad, 3% of GDP. We're at less than 1 right now. We think there is lots of room to go forward. That will drive the markets. I think you're right, though, about what's going on in geopolitical, that it's kind of, we've got to be sensitized to geopolitical risk. If you look historically, there's been a lot of geopolitical risk that has influenced the market, hasn't created the market, and it hasn't been bad for the market, and they've been very short-lived. So even when you do have something that happens, we believe that that's a buy on the dip. And historically, that's always been the same. Do we have different characteristics in different circumstances now? And is the Trump administration really testing the boundaries of how much authority that he can and does have? We think, for instance, from a Greenland perspective, we believe that the Greenland probably is not going to happen the way Donald Trump is threatening. We think it'll be in the headlines for a very long time, create volatility, but we think eventually that'll get solved and the market will see through that. Traditionally, when you have geopolitical risk, the dip is very fast and the correction is very quick as well. And the long-term price return over the next 5 years is exceptional. Even Liberation Day, I mean, we had a 20% drawdown, and then the price return since then has been 16%. The beginning of the trade wars, the only one that was a dip that didn't bounce back very quickly in history was the Russian invasion of Ukraine. And that did bounce back, actually, and it wasn't quite as quick as the others, but it did bounce back and has bounced back as we move further away from that. So geopolitical risk has been an opportunity to buy on the dips, John. We're not saying that this is a market that's going to continue to go up. We think there are opportunities to be defensive. There are opportunities to broaden out and not have as many of your eggs in those large cap baskets. But we think the overall market is still in a very good spot. The S&P 500 is, our prediction is low double digits, low to mid. So we're not in your camp. We're in that majority camp, but we see lots of opportunity going forward with monetary and fiscal policy, at least for the next year, to be positive.
Okay. All right. So we'll have to agree to disagree. One of the things about forecasting is a mouse game. So I don't want this to come across as being a forecast on my side necessarily, so much as it is a concern. I'm worried that so few people seem worried. When 97% of the population thinks one way, I intuitively, it's just my natural instinct to think that there's not enough consideration being given to the other side of the discussion. And so I wanted to read it into the record, because in the previous discussions you and I have had, I've said, okay, well, maybe, but we'll see. This time, I have to confess, I am more worried than I was the last couple of times, because of, I believe, the geopolitical climate having radically changed in the past while. And then secondarily, the fact that so many people in the industry seem complacent, and to the point where that's when you let your guard down. And I worry about that.
Well, it's very good points, John. And listen, the exuberance we see in the market and the predictive nature going forward of lots of the people that were on the call, I'm with you as well. I work with our Canadian equity managers. I work with our infrastructure managers. I work with our international growth managers, all from a Canadian lens. And they all have a little bit of different opinion on what's going to go on in the market. And I think the best thing to do is to prepare and participate in the upside, which is truly what we all want to do. I mean, we've all seen those nuggets. If you miss the top 10 days in a year, you have a hard time keeping up with the market or really having some substantial gain. However, there is prudence to prepare for that downside. So I think a good balance, John, I think you're not off base by that. Doesn't mean the S&P 500 can't perform well and markets can't perform well. You don't always have to have the top performance in those exuberant markets, but you certainly want to be able to protect on the downside when we have those pullbacks. And we will in this 4-year period that we continue to see upside. It's not going to be a straight line. There will be lots of opportunity for downturns, and probably downturns happen. And listen, if you drop 50%, the next year you have to gain 100 to be even. So there's a lot of different profiles on your performance. I think you're absolutely correct in being concerned. And whether we're right or you're right or I'm right, if you're prepared that way when it comes from an investment perspective, I think you do your clients well.
Right. That's a great way to end. I want to thank you for your time today, Dave. It's always a pleasure, and I want to wish you all the best in 2026.
You too, John, and I hope that everyone who listens to this has great success, and fingers crossed, maybe we'll talk about this and I'll be a 4-time presenter on your podcast. I'd love that.
I'm looking forward to it. Okay. Thanks, Dave.
We'll see you soon, John. Thanks so much.
This podcast is not to be construed as offering specific investment advice. Please consult a qualified advisor before acting. My books, Stand Up to the Financial Services Industry and Bullshift, are available online. If you'd like to meet to discuss how the topics in this podcast affect you directly, please visit my website.